Good morning, everybody. This is John Blank, Zacks Chief Equity Strategist and Economist, and it's Monday, September the 25th. Today, we're going to go through the Zacks review of consumer inflation trends. Of course, these are critical to both Federal Reserve policy and, for this particular talk, consumer staples fundamentals and our top 10 consumer staples stocks. So how we're going to do this today is we're going to go first through a deep dive into the U.S. inflation trends at the macroeconomic level, as well as talk about the financial markets, the risk markets, and the risk-free markets. In part two, we'll go into consumer staples, the trends that we see from our Zacks industry fundamentals. We do have consumer staples industries at Zacks, and we will go through them piece by piece through their fundamentals. Part three, we'll actually do the top 10 consumer staple stocks. We have here at Zacks, 3 of them are European, 7 of them are American. So there is a slight European bias to these 10 stocks, but they are a nice wrap up for a discussion like this. So we're going to move through economics, through NSU fundamentals, and then to stocks. Okay, so let's start off with a deep dive into U.S. inflation trends. Number one, of course, we need to define inflation, and there are 3 needed general definitions. I've explained this many times to the Zacks editors. As basic as this is critical for review. The CPI is a measure published monthly by the U.S. Bureau of Labor Statistics, the BLS. The BLS. So this is for the Bureau of Labor Statistics purposes, including the cost of living adjustment for Social Security. So the CPI is not economy-wide. It is labor market specific. That's why it comes from the BLS, the Bureau of Labor Statistics. Please understand that. The PCE, the Personal Consumption Expenditure, is a measure produced by the Bureau of Economic Analysis. They are different bureaus. Labor is the Bureau for Statistics on the labor market. That's the CPI. The entire economy comes out of the Bureau of Economic Analysis. That's the PCE. And the core PCE is the one that the Federal Open Market Committee makes interest rate decisions on. So core PCE is actually used more frequently by the Fed. They don't ignore the CPI, but they focus on the core PCE. Keep that in mind. Now, upstream of either the CPI or the PCE is what's called the PPI, the Producer Price Index. It is similar to the CPI, but it's inflation businesses experience in their supply chains and business expenses. So this is a supply chain thing. Why this matters, of course, is the PPI will reflect downstream into the CPI and the PCE, but it will also show us in this context the post-COVID supply chain reaction. That is critical here. We need to understand both supply and demand, and COVID has both responses causing inflation and the dissipation of inflation to whatever it comes to be, maybe disinflation. We will see. So those are the different avatars: CPI, PCE, and PPI. All right, the Consumer Price Index for urban consumers. This is over the last 20 years, 25 years actually. And down here, you're going to see the actual definitions in hand. So, of course, up here we have all items, the core, apparel, and commodities. Over here, we've got education, food and energy, durables, that's critical, electricity, energy, food and beverages, and housing, critical, energy, non-core, and over here, of course, medical care, medical services, non-durables. Medical care and services, of course, somewhat COVID related. Down here, recreation, critical for the COVID period and post-COVID period, as well as transportation. So let's look at the more important, larger movements. First of all, the CPI and commodities right here. Commodities did run up quite dramatically during the COVID period, but they have flattened now. Keep that in mind. Apparel is actually moving up quite strongly, and it didn't for decades. It was actually disinflating. So interesting to note that apparel has actually gotten somewhat stronger during the post-COVID period, COVID and post-COVID. Those are more important. Interesting. Here, we're looking at all items, and you can see that it picked up after COVID through 2021 to 2022, and now it's slowing down. That's the gradual end of that slope. And you can see core is actually above broad, which is actually rare to see that. In general, it doesn't, they track one another, keep fairly close, but you can see at this point in time, they've done this. And this has actually been the case during the periods when energy doesn't play much of a role. Of course, that's changed now. Durables, keep this in mind. Durables surged during the supply chain event of COVID. People really wanted, your washing machines, but now it has flattened for 2 years. Over here, of course, energy, the Fed does not care about energy as much as people think they do. They do not. And you can see why, because it's very spiky. Energy is very spiky relative to all these other charts. Let's look at it. Just don't even care about what's going on. Just pay attention to that. Now, electricity is actually macroeconomic, and you can see a sign of slowdown here with electricity topping in early 2023. So keep that in mind. We're learning something from electricity CPI. It has topped. Over here, you're going to look at medical care, and of course, this actually topped during the exit from COVID, and it has come down because there was demand for healthcare, of course, during the pandemic. Now it has slowed down. And down here, you can see transportation recreation really spiked up, particularly transportation. People got moving, car issues, this is the auto and used and new thing, and the recreation. Again, recreation seems to be rolling over, but it has had an immense run. That's your revenge travel. That's your, people out there really looking for things to do now that they're home. So keep these trends in mind. Come back to them as we need. Upstream of price inflation, upstream, not downstream. Downstream would be actual consumption, and consumers. Upstream would be the producers. So again, let's take a look at this. What do we see here? Copper. Critical. Dr. Copper tends to forecast everything, and you can see Dr. Copper had a great run during the early COVID pandemic, and now it has been flat for 2.5 years. So actually signaling a soft landing from copper. Aluminum actually peaked in early 2022 and has come off and been soft. This is actually true for all commodities. So there's actually evidence of disinflation within the commodity space now, and has been since people left the vaccination period. Down here, want to point out that everything has rolled over here in the goods space starting after the vaccination period. This is critical to understand. Goods have stabilized and disinflated. And of course, look back here over time period, they generally were flat. So the issue is, are they going to stay flat like this again? But you can see they went from 113 to 146. We got a 30% move up in those prices for final demand. And that is, baked in now. It's reality. Steel. Keep this steel in mind. That's like commodities, and you can see it spiked up and has come down, but it's no longer as cheap as it used to be. This is actually bullish. You can see at this point in time, it has come down. It has disinflated, but it's at a much higher level. This is true for commodities generally. There's still a strong manufacturing push across the space here. This is showing you that, yes, they're disinflating, but yes, they're much higher. So there's more demand here than there used to be. Keep all that in mind. All right, time series 2. Final demand construction here. I want to focus on it. There is a critical piece. It built up during the COVID period and stayed high here and stable for some time now. Energy, of course, spiked and went down. Food obviously went up and now has disinflated. And you also see this with transportation, warehousing, disinflating, and down here you see steel products disinflating, but still staying, like I said, at a high level. Total manufacturing industries, worth pointing out that they have stabilized for 15 or 18 months, but they're not really going down dramatically. Again, I read all of this here and before set 1 and set 2. It's basically a lot of soft landing narratives down upstream from CPI inflation, and then, of course, downstream we have the other stories of the consumer. But there is a player that's critical here, and that, of course, is the financial variables and the Fed. And of course, the term structure of rates is critical to point out here. And we're seeing a very interesting inversion here. You can see that the 1 year is tops and 10 years is lowest. And that's literally not happened at all for this entire period, other than spaces like this, which were basically brief and very different. So critical to point out, the yield curve inversion here is steep. This is related to the difference in the steepness of the trajectory of inflation itself. And people thinking it's going to come down hard faster. The market thinks it's going to come out harder than the Fed. This is basic point here. These are market trader perspectives. The Fed does not control all of this. They're out of this business. They did control it back in here with QE. They don't control it now because they're getting rid of QE. So over here, you do have the Fed funds rate, and they do control it. And you can see that they are back to here. And of course, there they stayed flat for close to a year before they came down in the face of the financial crisis. They didn't come down because they wanted to. They came down because they had to. So will that happen again? That is a question to watch. Here is what I'm talking about, QE playing out and coming down. All the M1, M2, money zero maturity stuff and prime rate is coming down. That's no longer QE. You can see that has this effect straight ahead. Keep this all in mind. Over here, tips. I just want to point out that all the tips, whatever the maturity, are back to where they used to be in 07. So I want to point out here and here, relatively speaking, we're just back to the 07 period. We're not in an extreme period at all. It has come extremely fast, but it is not extreme. Keep that in mind. All right, on to consumer staples fundamentals, trends and fundamentals. Again, for this part, I highly recommend getting these slides from us because of the Zacks specific fundamental industry charts that we're going through. All right, number one, top line, cash flow and CapEx. Here is your revenue forward 12-month for the various industries. Here is your cash flow free adjusted, and down here is CapEx. Just want to point out that, for example, let's take beverages and apparel. We are seeing them, revenue growth wise, continue on in a fairly strong fashion. Over here, you see soaps and cosmetics has flatlined, tobacco has flatlined, but food has come up. So here again, you're seeing some definable fundamentals that are improving for their industries. Food be one, apparel would be another, and beverages to be third. So people are definitely food, beverages, and apparel. Keep that in mind. The personal consumption, personal consumption, small item personal consumption is very high. So what's going down and is not so high? We'll see. But also down here we've got CapEx and free cash flow. I just want to point out that from a free cash flow perspective, these industries are doing just fine. And down here, we've got CapEx. And of course, there's a lot of different stories here. Main thing I want to point out is they actually had more investment in a prior period than they do now. CapEx has not been a big issue for the consumer staples industries. Okay, profitability. EBITDA margin, keep this in mind up here. Of course, you're paying for profitability, and beverages are much stronger in profitability than apparel. Soaps and cosmetics are much stronger than food. And of course, tobacco is actually a very profitable business. Like it or not, it is. It's actually the most profitable business, a 50% profit margin. Next down is beverages at 33 profit margin, then soaps and cosmetics at 26, and apparel at 15, the lowest. Keep these in mind. All right, so let's skip the pre-tax margin and the debt to capital because it's just not as interesting. For us as stock investors, profitability is interesting. Keep these profit margins in mind. All right, balance sheet metrics. Should we care about all this? In general, I don't think so. I think it's kind of interesting to look at the return on invested capital, but it doesn't seem to vary much other than it's kind of in this space of between 6, 7, or 8% for these. And actually returns on apparel are pretty strong in the COVID period, like I said, but they weren't any stronger than they were before. I don't see anything moving up above its traditional historic areas. So I think this particular chart is not too helpful. On more balanced sheets, I want to point out down here, enterprise value per share is really critical, where it's the start of share valuation. Times interest earned and enterprise pureness, earnings pureness are just different issues for the balance sheet. I want to get down here to talk about share valuations. Critical. Share valuations, obviously, the run up in apparel was strong. It's actually much down towards historical norms now from this perspective. And beverages is still building. So beverages, as we've seen and talked about from a fundamental perspective, profitability, revenue, and of course now share valuation being picked up. People still buying the beverage story. Keep that in mind. Soaps and cosmetics have come down. What's building? Really, it's tobacco, whether you like to say it or not, but tobacco's not reaching extremes that it got to before. It's just getting back to its norms. So the only thing I'm picking up here is beverages has a somewhat of a strong positive trend. Everything else is not that interesting from this perspective. All right, these are more key share valuations. This is the forward 12-month PE to earnings growth. This is your PEG. And this is your price to sales, and this is your free cash flow to net income. PEG, of course, is critical. And you're going to see you want to be in a 2 or lower range for a good PEG. So do we see that? Actually, we do see that with apparel. Beverages is actually, not too high, but it's just kind of where it should be. There's no value there. And of course, over here, we've got soaps and cosmetics, which are looking a little high. And food, of course, looking a little low. So food and beverages actually somewhat of a play here. I think that's the story here. Probably people bought these stories in COVID and got rid of them. Maybe there's some play now back in food and beverages. Keep that in mind. Price to sales, a lot of differences here. Beverages is pretty high from a price to sales perspective, but that's specific to its industry. And all down here, we got free cash flow and net income. That's just a measure of that's not quite as relevant for us as shareholders, but important. All right, earnings yield payout ratio, and down here, enterprise value to profitability. Again, this is the one we want to look at closely. So what is the market like? I think, you're seeing some beverages playing here, most of all. And I don't see anything else other than some COVID interaction. And then a post-COVID period, very critically obvious over here. But again, it's that beverages story that looks kind of good. All right, now we're back to our top 10 stocks. Top 10. Not necessarily the best, just our top 10 of biggest ones that you can understand. So, first of all, we do have 3 European large cap names. One here is Nestle, which returned 675%. Is actually the best of these names here. Pepsi, Procter Gamble, Coke, and Walmart. Actually, Nestle did better over the last 20 years of time. You made 675% return on Nestle. Keep that in mind. Maybe a European name is worth playing here, and if there is one, Nestle might be that one. Unilever and L'Oreal returned 420 and 380. So clearly, Nestle was the better play. On a forward look, good question. A lot more to answer on that point. The top stock in this entire space has been Costco. 2,487, 2,500% return over the last 20 years. So just do the math there. You can make a really solid return just owning Costco and nothing else in this entire story. Anheuser-Busch down here, Philip Morris, the tobacco company right here, actually not a good return stock over time. Budweiser, of course, the worst. Interesting to note that it's not in beverages, Budweiser, that you wanted. It was in PepsiCo and Coke that you might have wanted to play. Keep that in mind. Again, more specific information on stock-specific performance over industry performance and macroeconomic performance. That is always a story here, and we want to keep in mind these are 3 different thematics. And to play them, you actually have to get down here into the stocks and who's positioned best. This is the critical point in time we're at now. All right, so here again, of course, I got Walmart, Procter & Gamble, Nestle, Coke, and Pepsi. And like I said, here's the nice charts for Coke and Pepsi. Pepsi looks a little stronger than Coke. And of course, Walmart's had a really nice run because they're building out their internet business during this period. They really used that COVID period strongly for that purpose. And down here, because Nestle's in a European index, it's kind of deflated. But you can see here, still getting those bids. Really like those earnings estimates for P&G, but there's actually seems to be some value over here for Nestle because the European markets are much worse. But look at these nice earning estimates from Coke and Pepsi. This is really, really solid stuff. That's what you want from an investor perspective, Coke and Pepsi. Look at those, really nice. All right, L'Oreal. I mean, really a growth stock here again, probably positioned for some value. And it's a European stock. Costco, phenomenal company, phenomenal stock. And you can see why with the earnings estimates there. It's just really, really good. Unilever, Budweiser, and Philip Morris are, of course, staggering around in the earning estimates. So these are the three you probably want to throw away as an investor looking for Costco and L'Oreal being your better bets on this stuff. Okay. Keep in mind, Budweiser is Anheuser-Busch InBev. There's a European and a U.S. conglomerate now. All right. So that's it, folks. Thanks for attending. It's John Blank. I do have a PhD, and I am the chief strategist and economist at Zacks Professional Services for this particular video. So if you want to get a hold of us, 866-794-6065. Send us an email at strategycall@zackspro.com. Find us on the web at zackspro.com. We do have a LinkedIn page under Zacks Professional Services, and on Twitter it's at ZA Tools. To get these slides, email or phone call is best. I'll repeat these, 866-794-6065, and the email strategycall@zackspro.com. Thanks much.